Welcome everyone, and thank you for joining us. My name is Ian Cullis. I'm the Vice President of Sustainability at LandlordBC. Today's session focuses on the clean technology uh, investment tax credit and support available through LandlordBC's rental apartment retrofit accelerator, um, which is administered by the team at Fresco. Before we get into the technical content, I'd like to spend a few minutes providing some context on why Landlord BC is focused on retrofit acceleration and how today's webinar fits into the broader work that we're doing across British Columbia. For those that may not be familiar with Landlord BC, we are the province's leading association representing the rental housing sector. While advocacy remains and is a core part of our work, we're increasingly focused on helping housing providers navigate energy efficiency, decarbonization, and building retrofit opportunities. Our role is to work with governments, utilities, and industry partners to help building owners overcome barriers and access practical solutions to implement retrofit and energy efficiency work. And the rental sector represents one of the largest opportunities for energy and emissions reductions in British Columbia. Much of the rental stock was built in the 60s, 70s, and 80s and is now reaching its midlife. This is a point where major capital repair and major capital cycles occur, and owners need to make decisions about how they implement those retrofits. So making decisions about heating, hot water, ventilation, lighting, and broader building renewal projects. The challenge is technology has changed. We have a variety of incentive programs that are available, and regulation and policy is changing as well. So these retrofit projects are complex and expensive, which is why navigating the incentive and financing supports is increasingly important. So through our work with building owners, we've found that projects typically don't stall because of lack of interest. They stall because owners need clarity, confidence, and support. They need to understand what options are available, whether the business case makes sense, and who can help them navigate the process. Today's webinar is really about one of those critical pieces, strengthening the financial business case for retrofits and understanding the support that's available to help you move forward. And to that end, understanding the business case is only part of the solution. Owners need practical programs that help them move from planning to action. And so an example of a program that's available for our members is our new lighting rebate program. So this is developed in partnership with BC Hydro and our partners at Brightlight. And the reason we're targeting this is lighting upgrades are often one of the simplest and most cost-effective retrofit opportunities available to building owners, and a good spot to start on your retrofit journey. So the goal of this program is to simplify access to incentives, reduce administrative burden, help owners move projects forward more efficiently. So while lighting is a relatively straightforward measure, it demonstrates the type of practical support Landlord BC is developing to help building owners take action. And while this program focuses on a specific retrofit journey, we recognize the need for broad support across the entire retrofit journey. That's really what led to the creation of the Rental Apartment Retrofit Accelerator, or RARA. Landlord BC has partnered with Fresco for a long time, and this program is to help building owners navigate the complexity of bigger retrofit projects and helps with support from planning through to implementation. The program connects owners with technical expertise, incentives, financing opportunities, benchmarking, feasibility studies, and project support. And one of the areas we're seeing a lot of interest is the clean technology investment tax credits. This is a financial option that can significantly improve retrofit economics when applied correctly. Today's presenter, Jasmine, has looked at these opportunities and will help explain how the tax credits work in practice. Oh, okay. Anyways, with that, I'd like to introduce today's presenter. Jasmine from Fresco has been working directly with building owners, project teams, and is ready to describe the programs that are available to you. So, Jasmine, with that, I'll hand things over to you.
Great. Thanks so much, Ian. And hi, everybody. Thanks so much for joining today. So, Ian, if you don't mind, yeah, here's a little slide about me. I'm a policy and strategy consultant at Fresco. I have been working on research and creating guidance related to the Clean Technology Investment Tax Credit for the past year now. So, yeah, Ian, can we go to the next slide? Great. So just before we begin, I do want to share that the work that we're doing today is part of the federally funded initiative through National Resources Canada, which is focused on building financial and workforce capacity for deep retrofits. And this is being funded through the Deep Retrofit Accelerator initiative. This is something that we're doing in partnership between LandlordBC and Fresco. And really, the goal today isn't just, to share research. It's really to build education, provide tools for the industry to help make retrofits more feasible. The issue that we're seeing right now is that there are opportunities like the Clean Technology Investment Tax Credit that are available, but they're severely underutilized. So the goal of this presentation is really to spread knowledge and awareness. So we can go to the next slide, Ian. So today we're going to walk through a practical introduction of the Clean Technology Investment Tax Credit, or CT ITC, specifically through the lens of a building retrofit project. So this is a really complex tax credit. And a lot of people find it kind of difficult to navigate at first. There's not always plain language materials available. And this tax credit doesn't really work the way that a typical retrofit program would. Again, we'll go to the next slide. And just quickly to introduce Fresco, we specialize in building decarbonization and energy efficiency. We do work across like engineering, policy, programs, training, building assessments for a range of residential and commercial building types. And we've worked with a lot of landlords. We worked with LandlordBC for quite a while, along with rental housing across BC. So we're bringing both technical and practical experience to our work. And Ian will go to the next slide again. So the goal really of today is to break down CTITC into a more practical way, understanding what it is, where it would apply, and what to watch for early on in a project. Next slide, Ian. So the goal today is not for you to become a tax expert after this presentation. There are professionals who can help to interpret all of the rules, who can confirm eligibility for you, who can guide the claim properly. But it is really useful to understand the basics, how the credit works, what types of projects would qualify, and any of the common risks and pitfalls that kind of emerge. So that way, if you're considering a retrofit project, you'd have enough context to be able to recognize when this credit might actually be relevant, and when it's worth bringing in or getting an opinion from someone who is an expert. So we'll go to the next slide. So tax incentives can be a really important tool because they can really change, as Ian was saying, the economics of a retrofit. At a very basic level, they can reduce the cost of buying and installing eligible equipment, and it can really help improve the financial return and make a retrofit project easier to justify. And in some cases, the extra financial support can also be the difference between doing a smaller, more basic upgrade and being able to do a deeper retrofit that would be able to provide a greater value. So this is where the opportunity can get missed. The CTITC is a creation of the federal government, and they position the clean economy tax credits as a very major policy tool to support clean investment. The early numbers have really shown slow uptake, and it's been a little bit slower than expected. Finance Canada projected billions in claims by the end of 2025, but as of mid 2025, the payouts were very, very limited. So the figures are for the broader clean ITC package. There are 5 other credits aside from the clean tech, which we're speaking about today within the clean economy umbrella. But the point still stands in that there's a big gap between the scale of the program and how much is actually moving through the system. So the reality is that the tax credit is very complex. To anyone who's looked through, the websites online and tried to get information, there are a lot of hurdles to even being able to understand how this works if you're not an accountant or you're not an expert. So there's a really low awareness overall for the CTITC. As I mentioned earlier, there's a huge lack of plain language resources available. There's also a lot of uncertainty around the types of, eligible equipment, what refund amounts would be. And there's also a pay to play barrier here as well, where owners really have to rely heavily on expert advice to be able to know if they even qualify. So before we get into this specific credit, I do want to quickly explain why the word refundable really matters. So with a non-refundable tax credit, it can reduce the tax that you owe, but only down to zero. So if the credit is worth more than your tax is owing, you don't get the extra amount paid out. A refundable tax credit is different. So if the credit is larger than the tax is owing, then the extra amount can come back as a refund. And this matters because CTITC is refundable, so it's much more useful in practice. So we'll go to the next slide, Ian. So now we're going to get into, the CTITC, which offers a tax credit of up to 30% for the installation of eligible clean technology equipment. Go to the next slide. So this tax credit was introduced by the federal government as a part of Canada's broader clean economy tax credit package, and it will be available until the end of 2033. Instead of only relying on grant programs, the federal government created this tax-based incentive to help encourage businesses to invest private capital in certain types of eligible equipment. So for building owners, this matters because a lot of low carbon upgrades can have high upfront capital costs, and a refundable tax credit of up to 30% will really make a meaningful difference to the business case of a retrofit. Next slide, Ian. So this slide provides a really useful distinction. So it's not based, the CTITC, on like meeting certain energy savings or emissions reductions, or meeting any type of performance target. And it's not like a typical retrofit or rebate incentive where you apply, you get a pre-approval, and you kind of know exactly what's coming. So it's a refundable federal tax credit that's tied to eligibility of specific equipment. And the focus is really on what was purchased, installed, whether it meets all of the eligibility criteria, and whether you have the documentation to support the claim. So it's more so better to understand as like a project work stream. And in order to de-risk claims that are filed at the end of the day, this needs to be planned alongside, design, procurement, pre-invoices before the tax filing actually occurs. The CTITC isn't really something that can be more of like an afterthought. It's really most strategically used when it's pre-planned before a project actually begins. Next slide, Ian. So here are the key eligibility requirements. So first, like who is claiming, what equipment is being installed, what types of costs would be included, what project conditions would apply, which would include the labor requirement, and also like what would happen after the claim. So a project would need to satisfy each of these criteria in order to be successful. Next slide, Ian. So now we're going to look at the eligible claimant. So the next slide will show who can claim is one of the most important. Next slide, Ian, please. Yeah, thank you. So, who can claim is one of the most important pieces to understand because eligibility isn't just about the eligible equipment, it's also about who owns it and how the building is used. So, in general, the credit is available to taxable Canadian corporations, partnerships, and certain real estate investment trusts. So, for many rental housing owners, the first question is really what is the ownership structure? On the other hand, individuals can't generally claim this directly, and most nonprofits or tax exempt entities won't be eligible. So, the other key point is that equipment needs to be installed in a building owned by the claimant and used for building or business or income earning purposes. So, if you're a rental housing provider, that income producing use is important, but you still need to confirm that the legal owner and claimant line up properly. Next slide, Ian. So partnerships can access CT ITC, but it's important to note that this ownership structure can slightly complicate things. So the credit will flow through the partners, but limited partners can be restricted by their at-risk amount. And this means essentially that they can only claim the amount of credit up to the amount of capital that they've actually economically invested and are exposed to losing. So this can become a bit of an issue for certain ownership and funding structures, specifically at the partnership level. So a project could be technically eligible, but still kind of fail to deliver the expected credit value because the ownership and financing structure limits how the credit will actually get used. This is one of the biggest reasons to look at CTITC before ownership or financing structure is finalized, not after. Next slide. And so the ownership structure is really the key business characteristic that determines eligibility. One thing that is helpful is that CTITC doesn't really depend on like the size of your business or like, the amount of revenue, employees, or total assets. A small or large corporation could be eligible. The distinction again is just that tax exempt entities, pension funds, some trusts or not-for-profits, and certain partnership structures will face barriers in accessing. And for building owners, it's good to know that you shouldn't just assume eligibility is based on the building. It's important to look at who owns the equipment, how the entity is structured, whether there are any partners, leases, or financing arrangements that could also change ownership in that analysis overall. Next slide. So now let's take a look at the types of equipment that are eligible. Next slide. So with typical retrofit rebates and incentive programs, the whole project is usually what's in focus, but it's good to remember that eligibility for this ITC is based only on the specific clean technology equipment categories, and we have them all listed here. So for most building retrofits, the most relevant technologies would be air source heat pumps, ground source heat pumps, solar, and battery storage. Of course, there are other retrofit measures that are important for decarbonization and energy efficiency, but they aren't necessarily captured by the CTITC. Next slide. So for building retrofits, the strongest examples of eligible equipment would be like heat pumps, central and in-suite systems, rooftop makeup air, domestic hot water heat pump systems, solar PV, and stationary battery storage. Solar is actually often described by accountants as being one of the most straightforward ITCs to claim, which is good to know if you have a solar project coming up. Next slide. And on the same time, there are a lot of retrofit measures, as I said, that we care about from a building retrofit perspective, but that might not necessarily be eligible. It's like building controls, envelope and enclosure systems like windows and insulation, lighting, among others, are not measures that the CTITC will be targeting. Even like electrical service upgrades can be a common area of confusion. A building may need an electrical service upgrade to support decarbonization or even eligible equipment installations, but it doesn't necessarily mean that the full electrical upgrade would qualify for this tax credit. Next slide. And then as well, there are some additional eligibility requirements. The equipment needs to be new. There was recently a change where equipment can be refurbished, but there are certain requirements in order to actually use the refurbished category. It also needs to be installed in for use in Canada and used for business or income earning purposes. The equipment also needs to be available for use within the program timeline, and available for use is an important concept. It's not just the invoice date from the contractor or the date that the equipment arrived on site. It connects to when the equipment is operational and ready to perform its intended function. So, for projects that might span multiple years or that might be completed in phases, this can affect which tax year the claim will belong to. So overall, equipment eligibility can be one of the trickier parts of this credit. There isn't one simple official list where you can kind of go to check off every piece of equipment that you have. The eligible cost will be determined based off of the technology you're installing and other factors. And it's important to know that the credit applies to the eligible equipment, not automatically to your full retrofit scope. And this also means that for hybrid systems, it's not the whole system that would qualify. Generally, it's only the eligible, like electric heat pump portion, which would be eligible for the credit. Next slide. So yeah, you might be wondering which part of the heat pump system would qualify. And at a very high level, the main heat pump system itself is like the cleanest eligible component. So this would include like the indoor and outdoor units and any core component that is necessary to allow the heat pump to function. So some supporting components may qualify if they're directly required for the eligible equipment to operate. But for anything that would be considered broader building infrastructure, there is some caution. Things like ducting, hot water tanks, building controls, electrical panels, load management technology wouldn't automatically qualify just because they're a part of the project. The safest approach is really to separate eligible and non-eligible costs during procurement and in invoices to be able to show what was the eligible equipment and what wasn't. And then again, reminding that just because a cost is necessary for the project doesn't mean it's necessary for the heat pump system. So that distinction really matters. And on the next slide, I have an example. So here we have an air source heat pump system, and this is useful because it kind of shows that boundary. The heat pump portion would qualify, as you can see in the green box. The natural gas furnace wouldn't, and the surrounding distribution system would also likely not be eligible. So again, this shows that for hybrid or dual fuel systems, only the eligible electric heat pump portion should be considered for CT ITC. Any fossil fuel backup portion is outside of the realm of the credit. And this is where the wording matters as well. If something's called low carbon heating system, it's not just enough. You need to identify which assets are actually eligible clean technology property. So for the next slide, we'll talk a bit about the NRCan technical opinion. So NRCan provides what they call a non-binding technical opinion on equipment and component eligibility. And for anyone considering this credit, I would highly recommend that they submit one for clarification. You will need professional assistance to be able to kind of put together the technical opinion package and submit, but it can provide a really useful breakdown of the eligible project costs and ineligible, and even a greater understanding of what equipment types would be eligible. And I guess this also kind of points to like understanding what NRCan and CRA both do in here. So NRCan handles all the technical eligibility. They would be the entity that would clarify if your equipment qualifies as clean tech property. CRA actually handles the claim itself, like the filing, the review, audit, the assessment, any recapture and payment. So you often will need both technical and tax input when trying to kind of navigate this tax credit. Now we can go to the next slide, Ian. Thanks. So now we'll quickly look at eligible costs. The next slide will show that eligible costs are generally connected to the capital cost of eligible property. This can include equipment costs, installation costs, delivery, testing, among others. And in some cases, professional fees that are directly tied to acquiring or putting the eligible property into service are also included. There's often a lot of confusion around soft costs. So, for example, a feasibility study that is looking overall at a project and that's kind of asking the question, like, should we do this project? This would be treated differently than an actual detailed engineering design that is looking at the installation of the actual equipment in the building. So the feasibility study likely wouldn't be eligible, but the detailed engineering for a piece of equipment would. Permitting, financing, preliminary studies, any type of like general project development costs won't qualify as eligible under this program. Next slide. Yeah, so now we'll also just look at some of the project conditions. Next slide. So the labor requirement. This is often cited as one of the most confusing and high risk parts of the program. So where the labor requirement applies, meeting them can make the difference between getting the full 30% credit or it being reduced down to 20% if not met. And it's good to have a solid understanding of what the labor requirement is and when it actually applies. Next slide. So the labor requirement has two main parts. There's the prevailing wage and apprenticeship requirement. So the prevailing wage means that workers need to be paid according to the applicable benchmark rate. This looks at both the region that the worker is in and the work being performed. The apprenticeship requirement means that registered apprentices need to complete a required share of Red Seal hours where the requirement applies. So the hard part is not really just complying, it's also proving the compliance. So this can require like very detailed worker level tracking, who is on site, what work they did, the type of work they did, how many hours they worked, what wage applied. I even recently read that CRA was asking for specific names of each of the employees that were on the job site. So it can get very onerous with regards to providing this type of documentation. Next slide. And with understanding which workers the labor requirement would apply to, it applies to any worker that's doing like manual or physical work connected to preparing or installing the eligible clean technology equipment. So the engineer who's doing the design for your project doesn't fall, their work wouldn't fall under needing to comply with the labor requirement, but your installers would. And this is anyone who's involved in the work. General contractors, their subcontractors, and installation crews would all need to abide by this. And the reason why this matters is because the requirement doesn't just sit with the building owner in practice. You need information from the contractors and trades that are involved. And it means that this all has to be discussed very early on in the project because it can be hard to collect the right documentation after a project is underway. Next slide. Positive news for this is that for most building retrofits and like our audiences, low carbon heating equipment is actually exempt from the labor requirement, which means air source heat pumps and ground source heat pumps, some solar projects would be would they be exempt and not have to follow the labor requirement that I've just said. For other technology, they would. But there's currently an exemption for these types of equipment. So for retrofits, the good side is that this isn't necessarily something you will likely have to encounter. Next slide. And yeah, if needing to comply, the documentation burden is quite high. Typically, we recommend needing an arrangement between contractors and owners. The level of documentation is not typical for typical retrofits, and you need to get like a lot of information from the contractor, like payroll records and wage evidence, apprenticeship tracking. The file needs to be really built when the work is actually happening. So you can't easily recreate this after the project is done. So if the labor requirement does apply, it's really something that should be addressed during procurement. And the contractors need to know what records they're expected to keep, how often they'd need to report, and what would happen if they don't provide that needed documentation. Next slide. And so overall, this applies to the project and to the labor requirement as well. If the contractor performs the work, the owner is still the one at the end of the day that's responsible for the claim. CRA won't accept that, like, my contractor said this was fine, or I was told by X person that this is what I'm supposed to do if it contravenes one of the eligibility requirements. If there's non-compliance, then the credit can be reduced. There can be penalties applied for attesting to the labor requirement if it's found that it wasn't met. And it can also just allow CRA to reassess the claim. So contracts need to include documentation. There needs to be audit support, a lot of record keeping. And it's really, the documentation burden is high, and owners just need to be aware that they're responsible for their claim at the end of the day. Next slide, Ian. Thanks. Yeah, so now we'll just look at the ongoing eligibility really quickly. Next slide, please. So the CT ITC is not just about, getting money back. The property has to remain eligible, in eligible use after the claim. So if the property is sold, transferred, removed, converted to like non-income use, or subject to certain ownership changes, recapture risk can arise, which means that the CRA can claw back the money, the refund that they gave. And this can matter for buyback arrangements, for any type of like sale, leasebacks, energy service agreements, third-party ownership, and any contract structure where the asset might change hands later. So we do highly recommend a very in-depth legal and tax review should happen before any type of arrangements occur, involving any type of equipment that would be leveraging CTITC, or that could change over after the claim is filed. Next slide. So here are some kind of like practical key insights that we are just going to share about everything we've just talked about, if you're considering, or someone you know is considering going forward and trying to claim this credit. Next slide, Ian, please. So one of like the biggest pieces of advice would be to really map the claim early before the project has started. So before your equipment is ordered, before the installation has begun, owners really need to know what technology is being claimed, who owns it technically, what costs are eligible, what costs are not eligible, whether rebates would reduce the cost base, what type of labor requirements might apply, and who would be responsible for record keeping during the duration of the project. And this can be especially important because many retrofit invoices, as I've said, are not naturally structured for CTITC. Contractors don't normally break out costs the way that the CRA would require them. And if the contractor gives a one lump sum invoice for the whole project, it can be much harder to separate later on. And it's been commonly cited as like a pinpoint, I guess, during the audit process. And you also want to make sure that the effort and expense that are required to really get this claim moving is also worth it. There would be like a minimum viable project cost, at least for the eligible equipment, that you'd really need to kind of think over to make sure that the refund is actually worthwhile to justify all of the professional costs that would also be involved. Next slide. And yeah, building the audit file is also really important. It is important to mention, I have here $100. I realized this earlier. It's actually 100% of claims are audited in the CTITC. The more expensive and complex the project, the higher and I guess more scrutinized the claim will be. So building the audit file really ties back into that early planning. Professionals are reporting like extensive review. There are short response windows. You have about 10 days to respond to any of the CRA's requests as they're going through your file once it's audited. And they'll request detailed documentation if you haven't provided it. And like I said, 100% of the claims are audited by the CRA. So this is something that you expect going into this. And your audit file really needs to kind of begin being built day one, and it would include a long list of necessary project documentation. Even if you don't need the labor requirement, there's still quite a lot of documentation that's needed. So you can never over document, it's been said, but you definitely can under document. And that's really something I think to keep in mind as you're kind of going through this. As well, it's good to know that CRA kind of assumes that all the claims in front of them are false, and it's your job in your claim to prove that you've met the requirements. So there is a very high burden on the claimant for proving that they're meeting each of the requirements of this tax credit. Next slide, Ian, thanks. And then also, this slide kind of speaks to the expectation for payback. So the tax credit is refundable. So you'll generate the cash back, but it might not necessarily happen very quickly. So CRA reviews should be expected, as I just said. But recently, people have said that the claims are taking much longer to process than owners assume. So in any of your financial models, when you're mapping out, you need to treat CT ITC not as like a guaranteed cash on a fixed date. You have to include the timing risks, possible review delays, any type of advisor costs, documentation costs, and the cost of capital while waiting for the refund in any of your planning. Next slide, Ian. And yeah, this really isn't something that owners should try to figure out alone. You need a tax professional who understands the claim in the filing position. You'll also likely need an engineer or technical professional who can help support equipment eligibility. So you also will need a contractor who will be able to separate the costs as you need them and provide documentation. And if ownership or financing is complex, legal input also might be needed. So prior claim experience for anyone that you're working with is really valuable because the market is still learning on this, and not every accountant, contractor, or engineer might have dealt with claiming this credit in the past. Next slide, Ian. So the main point I would really leave you with is that CTITC is extremely valuable, but it's complex and it's not simple at all. It really is a tax mechanism, not a typical retrofit rebate. So you don't need to become an expert in all the details yourself. But the important thing is to recognize when a project might be eligible and bringing in the right help early. If you're considering a project that involves eligible equipment and your ownership or corporate structure seem to fit, then the credit really can be a significant endeavor and enough to worth looking into. Any type of experienced accountant or advisor can help you talk through basic eligibility as well, with understanding the risk and deciding whether it's worth pursuing. So if you are going ahead, the biggest advice that we have is to treat this like it's a part of a project workflow. Map out the project, understand what documentation you'll need, get professional assurance early on. And even if you're not documenting the labor requirement for the full rate, you still need strong proof for the rest of the claim. So you really can't over document this, and it really helps to have a key point person who's responsible for keeping track of things. And you may need a few different people involved, a technical professional, as I've said, an accountant, and contractor who's kind of up for the show and willing to provide invoices and records that you need. And then the next slide here. There aren't too many resources that I can point you to. There is the NRCan technical opinion, where you can assess equipment eligibility. CRA, you can call them and you can get some guidance over the phone. There are online webinars like the one you're in right now, and there are more available online that you can find, and some online resources, though they are scarce. And I have included my email here if you have any direct questions for me. And so I'm going to pass this back to Ian. Thanks.
Sorry. Thank you, Jasmine. That was really interesting. Really interesting to hear about the technical components and the different pieces of the tax incentives. So thank you for presenting, and thank you everyone for joining us. I think if there's one message I'd like to leave everyone with is that retrofit projects are becoming increasingly viable as new incentives, tax credits, and support programs become available. The Clean Technology Investment Tax Credit won't make every project work, but in some cases, it sounds like it can improve the economics and make projects move from consideration to implementation. And I just want to throw this out there if you're exploring retrofit opportunities, we encourage you to connect with the rental apartment retrofit accelerator team. Um, we can help you evaluate opportunities, identify available incentives, and determine whether programs like the CT ITC may be available for your project. So I just want to say too that any questions you have can be posted in the Q&A. Um, so I think we did get two, and one has been answered. Um, so copies of the slides will be provided, and a video. We have recorded this presentation, which will be available as well. The other question that we have for you, Jasmine, is question comment. Um, Thank you for the informative presentation. Now clear why this program is underutilized. Um, if one owns small apartment buildings under 50 units, it's not obvious what the incremental cost would be to comply with the onerous requirements. Do you have a benchmark as to the minimum project costs to justify the additional cost to comply with the tax credit?
Yeah, good question. And this is one that we've asked. And anyway, so I guess I'll provide a bit of context there. So I have heard from one firm that their minimum, like bottom of the line, eligible project cost would be $50,000. That said, the CTITC has a range of different equipment types. As I've said, solar has kind of been considered like the slam dunk of all of the different types of technology. So if you had a solar project, for example, it might be more straightforward for an accountant to process. There might be less hours involved. So that type of project may be worthy to consider at around that price, but there will be a few different factors that will play into it. Overall, there are a range of accountants that are available. They all have different billable rates. Some accounting firms have created like packages, audit packages that are like lump sum packages for their hours involved in the project during the audit process. There's such a range of the amount of hours that are needed to be dedicated to the project because there are a lot of variables that I personally wouldn't just caution one specific number. I think the best guidance I could give you would be if you find an accountant that has or your accountant has experience, you can kind of talk through initially, see if your project is eligible and like at a very high level. And you can kind of ask about the complexities of like your ownership structure. If you're a single corporation, it's much more straightforward than a partnership, at least with setting up the entity and making sure that that's all done correctly. If you're just installing like a heat pump and there's no labor requirement, there will be less documentation that's needed. So again, it will be more straightforward, less hours involved theoretically to get your project to the successful filing. So it does matter about who you are in the project, the type of equipment. So yeah, I don't have, I would say like $50,000, but in my mind, I could come up with a range of scenarios where it would need to be way more than that. So it kind of would depend on a case by case basis. I hope that helps answer your question.
No, that helps a lot. It sounds like the program is really complicated, so getting that support up front is really important.
Definitely.
Um, do you know, so this one's more from me, but do you know if any buildings have participated so that we have like some peer-based examples that we could leverage?
Yeah. So we have helped a couple building owners in providing the technical opinion. I will say that as of as of March of this year, the CRA was still was still successfully like completing claims back from 2023 when this first started. So there is a significant backlog. None of the projects that I've seen have come to fruition with regards to being successfully claimed, but we have helped building owners in providing the technical opinion, and that's where we've gotten more insights into the specific types of technology that are eligible and ineligible. And that was actually through the RARA program as well that we did that.
So I have another question that's a bit different. So many 1970s purpose-built rental buildings don't have the electrical capacity to change over to gas-fired heat and domestic hot water to electric. Do you know if there's a program for this, as the cost can be quite high, approaching $1 million for the capacity upgrade?
Yeah, so I might have to defer to you, Ian. I'm not sure, you might know more about that than me. I have to say, I'm not completely well versed in all of the potential programs that are available. I can't really think of one that comes to mind that would provide any type of significant rebate. But Ian, if you know better, please
Well,
share.
yeah, and I think this one's quite different from the investment tax credits, but
Yeah.
the hard part is I think there's a it depends piece. In some of the grid constrained areas, there may be support available, but in many areas, BC Hydro will pay for like, but as soon as you're adding capacity, um, you really run out of support. Um, so I think through the RARA program, we've been looking at a variety of options to reduce the electrical capacity that's needed through things like load management or um, I just got another comment on the electrical supply or demand management. So we are looking at options to mitigate those costs. And I know through the RARA program, we've run into electrical capacity issues on a few of the buildings that have participated. And it's true. It can cost much more than $1 million for the electrical service upgrade. But then there are other problems like the size of the new service. So then you have to deal with where you're locating it, notification to um, tenants if you're taking over their parking spot. So yes, it's complicated.
Yeah, and I think, and that's why too, like, we really do recommend that if you have questions or you have a retrofit you're thinking about, to reach out through the RARA program because it really is like a one-stop shop full like support program that will have like, our engineering team, we have our rebate team that knows a lot about the different rebates that are available. That can really help guide your project and understanding what incentives and what rebates are available, and kind of looking at the challenges of your project altogether. If electrical capacity is one of them, being able to hopefully mitigate in using what technologies are available, like load management, maybe if it's relevant, or other measures, and just kind of looking at the full picture and being able to guide you best through it. So that would be our recommendation.
So just one last question for me.
Mhm.
Um, it's interesting navigating this piece of like you've got your full project cost. You obviously need to get that support up front to break out the different pieces and eligibility and some of the hurdles around what like the labor rates, the RFPs and pieces like that. Um, I guess in terms of the included or excluded costs, it can get interesting, right? Because you've got like a domestic hot water system, there's the insulation, high efficiency pumps, the mounting brackets.
Mhm.
Do, is there a whole list of what's eligible or not eligible?
Yeah, that's a good question. There isn't like necessarily a list. NRCan has actually recently provided more. This was completely unclear. Like last year when we delivered this presentation, there was very little guidance that was written with regards to like what types of costs are actually included. So NRCan has released technical guidance documents. They are still very like bare bones primary, I would say, with regards to being able to provide you with answering all the questions you've just asked. But they do provide a bit of an understanding. It is a bit of a gray area, and you won't really find like a full list of what exactly is eligible because again, it kind of depends on a case by case basis. The thinking is really if you if the cost is necessary for the primary equipment to function, there's an argument to be made for its inclusion. If not, again, for ducting, secondary equipment, distribution equipment that distributes the heated or cooled air through the building or water, then I think NRCan can kind of argue otherwise. But in the technical opinion, you can be granular in describing the system, and NRCan will provide some distinction with regards to what costs are eligible and which won't. So it's best if you have a project in mind, really to just submit for the technical opinion, and it will provide a greater clarification of realistically what costs you could expect to be included. And also going forward on this as well, we realize that there are a lot of gray areas and complexities with this program. And like we are continuing in-house to develop more resources and guidance and provide clarification on some of these questions that you're asking, Ian, so that owners don't have to go through such lengths to get all this information on their own, and that we can theoretically streamline some of this and be able to provide more clear-cut guidance and advice to everyone. So that is something that we'll be continuing to do through RARA and the DRE program as well, and creating more resources that kind of answer some of those questions.
That's perfect. Thank you, Jasmine. So we don't have any more questions in the chat, and you've answered everything, all of the questions that I had. So I just want to say on behalf of Landlord BC and Fresco, thank you for our participants' time today. I want to say thank you to you, Jasmine, for your presentation. It's really insightful and helpful. And we hope that this session has been useful. And through RARA, we look forward to supporting your future retrofit projects. And we will have more sustainability related webinars coming up. So we hope to see you again in the future. And obviously, don't forget to sign up for Landlord BC's e-newsletter to stay in the know. And if you are looking for any more information, our website's posted. So with that, have a great day and talk to you later.